now going to conclude Chapter 5 by covering Modules 6 and 7. And our first learning objective is to just take a very quick look and review at gross profit, but now we'd like to express the gross profit in percentage form. And when we express gross profit as a percentage, it's called the gross profit margin. So let's take an example. We know that the gross profit is the difference between sales and cost of goods sold. So if sales are $5,000 and cost of goods sold is $3,000, we know that the gross profit is $2,000. After the gross profit is calculated, we know that operating expenses are deducted to determine income and net loss. And as I've said many times, the definition of gross profit is the amount of sales dollars that remains to cover or is available to cover operating expenses and contribute to your bottom line net income. However, this becomes very useful when it's expressed in terms of a percentage, and that is known as the gross profit margin or the gross profit percentage. It's simply gross profit divided by sales. So from the above information, if we take sales minus cost of goods sold and get a gross profit of $2,000, that $2,000 gross profit divided by sales is 40%, and 60% is your cost of goods sold percentage. And as I said, it is one of the most important measures of corporate profit. For trend purposes, we would need to be sure that the gross profit margin is not deteriorating in any way, because this could be very detrimental to the company, because it then would have a very difficult time in covering its operating expenses, or even if it did cover, it would obviously result in a lower net income. In this example, let me just sort of give you another way to view this. In a very simple example, sales are 100. Well, let's say cost of goods sold is 60 and gross profit is 40. So if we represent it in terms of dollars, it's the gross profit. In percentage terms, it's the profit margin. If we express sales as 100%, your cost percentage is 60 and your profit margin is 40, or your gross profit margin. Now, what analysts will do is look at these percentages, compare them over time, and compare them to other companies in the industry. It is much more effective to compare a company in terms of percentages or relative terms rather than looking at it in terms of dollars. So, for example, if you look at our sample company with $5,000 in sales versus a company with $100 in sales, well, you might think, well, wait a minute, this company's gross profit is $2,000, so it is operating at a higher profit margin, and it's absolutely not true, because even the company with the $100 sales level is operating at a 40% gross profit margin. Our next and last learning objective for this chapter is to cover the periodic system. And as I said, the periodic inventory system is probably used for certain purposes, but it doesn't really help us control inventory, because as we said, the periodic system would result in inventory with cost of goods sold being calculated only at the end of the reporting period. So the only way that you would be able to get your ending inventory is to count it at the end of the year, and the only way that you would be able to understand your profit margin, your gross profit, and your cost of goods sold would be at the end of the accounting period. Now, under a periodic inventory system, it's very different than the perpetual system, because during the year, we do not record anything in the inventory account. A separate account called purchases is used to accumulate acquisitions. Our purchase discounts are recorded separately. Purchase returns and allowances are recorded separately. And freight is recorded separately in an individual account. Now, together, they make up the inventory. So the cost of purchases is the net amount of these four accounts. So in other words, if we took purchases, purchase returns and allowances, and purchase discounts, we then add freight to get what we would call the net cost of inventory purchased. So that's purchases minus purchase discounts, purchase returns and allowances, and we add freight. The negative items here, purchase discounts and purchase returns and allowances, are called contra purchase accounts. Now, going back to our Smart Touch example, here's the purchase invoice, and let's see how this would differ if we were looking at this from a periodic inventory system. Once again, all the components are the same. You've got the name of your supplier. You're shipping it to our sample company, Smart Touch. The date of the invoice is June 1st. The terms of sale are 310 net 15. That's a 3% discount if paid within 15 days. If not, the full amount of the invoice is paid within 30 days. We know that the cost to buy the inventory was $100. Was $350. They bought 100 units for $35,000. So those are their purchases. If they paid within the discount period, which they did, paid within 14 days, their net cost is $33,950. If they waited, which they didn't do in this case, it looks like, at the end of that period, they would in fact have to pay the full $35,000. So again, take a look at these explanations. It's very similar to the earlier example we did. In fact, the numbers are exactly the same. Now, the difference will be in the way in which we record this, because now we're using a periodic rather than a perpetual inventory system. So in this invoice, again, to review, we know they purchased 100 units. Their cost is $350, and the term is, of course, $315 net 30. The total cost of that purchase is $35,000. In a periodic inventory system, as I said earlier, each purchase is not recorded in the inventory account. In fact, the only balance in that inventory account until we make our period end adjustment is the beginning balance from the prior period. So the ending balance of last year becomes our beginning balance this year in inventory, and that's it. There's nothing else in that account, but purchases are tracked separately in the purchases account. So rather than having inventory affected by acquisitions, purchases are accumulated in the purchase account. Sales of inventory are recorded as sales revenue, but we do not record cost of goods sold, nor do we reduce inventory when the sale takes place. Cost of goods sold and inventory reduction are only determined at the end of the period when we take a physical count of the inventory. Now again, as we said earlier in the chapter, this is not very efficient because you cannot manage inventory very well using a periodic system. You don't have enough information on a timely basis. If this was perpetual, you would have inventory updated each time you buy units. When you sell units, the units would come out of inventory. You'd scan them out at the cash register, just as you would scan them in at the receiving dock when the shipment comes in. As I said, when you shop, you go to a register. The sales associate can tell you exactly what they have in stock, and they know what's in the warehouse or know what's in the stock room. If you're using a perpetual system, you know your inventory balance every day. You know your sales, your cost of goods sold, and your gross profit on a daily basis. On a periodic basis, however, on a pure periodic system, you cannot get that information until the end of the period, and you count physical inventory and use the cost of goods sold formula as we mentioned earlier in this chapter. Now, there is use for the periodic system. Sometimes companies will use a hybrid. They will use perpetual to control their inventory, but periodic for external reporting. Now, to illustrate a periodic inventory system, let's see what happens when Smart Touch buys those 100 units for $35 each. Here, of course, we'll still credit accounts payable, but as I said, we do not debit the inventory account directly. We debit an account called purchases. The account purchases accumulates all your inventory purchases in the year, and purchases is a temporary account. Temporary account, and it will be closed out to income summary. The $35,000 goes into purchases, and again, note that that will substitute or actually replace the debit to inventory that you see in a perpetual system. Freight. Assuming that you're paying freight, of course, this would have to be a case where it is FOB shipping point. So when the goods are turned over to the common carrier, the freight will now be recorded. Note that the freight is not recorded in the inventory account. It is recorded, it is not debited in inventory. It is closed to a separate account called freight in. This is an adjunct account to inventory. It is a debit to freight in and credit to cash. And once again, you are paying the freight to someone else. So maybe you're paying the freight to UPS, FedEx, but you're not paying the freight to the manufacturer of the goods, or you're not paying the freight to your supplier. In our original example, we know that Smart Touch paid early and got the discount, and it's the same here. We're going to assume that there is a return. We'll go through the journal entries in a minute, as we did throughout the chapter. So there is a purchase return, and we know that the return was for $7,000. So the net amount of the invoice is $28,000 at that point, or I should say the net amount of the payable. Since they're getting a 3% discount, please remember that the discount does not affect or is not affected by the freight. The freight is paid to someone else. This account payable is $28,000 for the merchandise only. You had $35,000, you returned $7,000, and therefore your balance is $28,000. And as a result, with the $28,000 invoice at 3%, you have a discount of $840. So that the amount that is due and payable is $28,000 minus $840, and you would pay off this invoice within the discount period for $27,160. And if you go back to the actual invoice, they give you a number. They tell you that, oh yeah, if you pay within the discount period, you would only owe us, $33,950. And of course, that is only if there's no return. Now let's see what the return looks like. And the same approach is used to account for purchase returns and allowances. In a periodic system, purchase returns and allowances, though, is a contra purchase account, not going to inventory directly, and it will be closed out at the end of the period. So in this case, we're going to debit rather than crediting inventory. You debit accounts payable and credit purchase returns and allowances. And to record the discount, you're going to pay off a $28,000 liability by paying $27,160. So You would debit accounts payable for $28. That removes the full amount that you owe. Credit cash for $27,160, and another contra purchase account. The purchase discounts would be credited. So again, using the same numbers we had before, it would look a little bit different, of course, because we're not going to the inventory account. We're using 4 separate accounts now. We're using purchases, the contra accounts, purchase returns and allowances, purchase discounts, and freight in. Prior to this, under a perpetual system, all of those events would have been recorded directly through the inventory account. Now, let's do another illustration. And let's assume that you go to the trial balance and you find that merchandise inventory has a 0 beginning balance. So maybe it's your first year of operations. The ending inventory is $31,290. And that was determined by a physical count. So this is a physical inventory. And that's the ending inventory. You purchased $281,750. You returned or you received allowances in the amount of $61,250. You got discounts by paying within the discount period, $44,110. And your freight in, again, FOB shipping point, if you're responsible for the freight, as the buyer, it's FOB shipping point. So, to close these accounts, you would have to debit all of the contra accounts and credit income summary. What is also important is that you would have to put the ending inventory on your books at this point, unlike the perpetual system that has updated inventory records every day. The problem here is that this inventory that you counted does not get on the books until you actually record it. So you have to debit purchase returns and allowances for $61,250. Debit purchase discounts for $44,110. And now you debit the ending inventory for $31,290. The credit to income summary is $96,950. Now, the next closing entry is going to debit income summary, credit the debit balance accounts of purchases and freight, and notice you also have to credit or remove the beginning inventory. So when you have a perpetual, a periodic system, the difference is that in the merchandise inventory account, you have beginning inventory, and that's all. As part of the closing process, you close by debiting the ending inventory, and you close by crediting the beginning. So notice that you are wiping out the beginning inventory, and you put the ending inventory on the books. So this did not exist until the very end of the accounting period. And the way we get the cost of goods sold, and of course, if we had a sales number, the way we get gross profit is through the cost of goods sold formula. Beginning inventory plus the cost of net purchases gives you the cost of goods available for sale, minus the ending inventory gives you the cost of goods sold. So beginning inventory plus net purchases less ending inventory would give you the cost of goods sold. And finally, you should use this as a comparison of perpetual versus periodic. So let's take a couple of transactions, just some samples, and these are assumed dates. You purchase merchandise on credit. If it's perpetual, you debit merchandise inventory, credit accounts payable. If it's periodic, debit purchases, credit accounts payable. So you notice you do not, under periodic, you do not debit the inventory account. Then you got purchase returns and allowances. Under a perpetual system, you debit accounts payable and credit the inventory. Under periodic, again, you do not affect inventory, but you would use a contra purchase account. Freight goes directly into inventory, debit freight, credit purchases. For periodic, but for perpetual, you debit the freight account directly. If you pay within the discount period, the discount reduces the cost of inventory under perpetual. It will reduce the cost of inventory under periodic as well. However, we need to first record it in a contra purchase account. Now, there are also some differences in the sales area. So, of course, when you sell the merchandise, it's identical. That's unaffected. Except that we do not record the cost of goods sold under a periodic system after each sale. So, when you have a perpetual system, there are two entries to record the sale. One to record the sale itself, and second to record the cost of goods sold and the reduction of inventory. When you have a periodic system, there is only one entry to record the sale. No COGS at this point. No COGS until the end of the period. Then, when you return merchandise, once again, looks the same. You debit sales, returns, allowances, and credit receivable, except that under a perpetual system, you got two entries. One, record the sales return and the receivable reduction. The second one is to restock the inventory and reduce the cost of goods sold. Once again, under a periodic system, you don't have to worry about, you don't affect inventory directly, so that you would not have the inventory restored until the end of the accounting period. And then finally, on the discount, and again, all these numbers are assumed, on the sales discounts, that would be exactly the same if a customer paid you within the discount period. So looking at this just in summary, let me erase that for you. Perpetual versus periodic. I think the conclusion here is that you definitely find perpetual superior as an advantage for inventory control. Definitely has an advantage. Or internal control. As we'll see, could have an advantage for external reporting in some cases. Now, we have to wait until we get into the inventory costing methods in the next chapter, but by looking at this, it's possible that some companies might use a hybrid system, using perpetual for internal controls and periodic for external reporting in some cases. Again, the advantage for external reporting will become clear when we look at the inventory costing methods in the next chapter.